Hello and welcome back to the Note. As this is my last note before going back to the US, let's talk about how the US economy is viewed from here in Europe. And many people, rather unlike the situation in the States, think that we could be heading for a recession there, albeit quite a mild one. With me now to discuss this is the CEO of Longview Economics here in London, Chris Watling. Chris, thanks for joining me yet again.
Pleasure.
Let's start by taking a look at leading indicators for the US economy. It's a composite measure, plainly not showing in recession at the moment, but obviously the direction is troublesome. What do you think is lying behind this? What are the factors that make you concerned for the US economy?
Yeah, I mean, I think the most important starting point is what we see in the corporate sector in the US,
Right.
where we've seen a distinct deterioration of the cash flow of the corporate sector, particularly if you add in buybacks as well, which a lot of people suggest you shouldn't, but given that companies aren't investing as aggressively as they might, it's kind of relevant, I think, in this situation.
Okay. So their revenues are not as strong as they were, and they're disgorging cash in dividends and buybacks rather than actually putting it back into the business.
Exactly, and profitability is weak, profit growth's weak, and of course the strong dollars undermine that profit growth, as the US has been seen as one of the last great bastions of global growth.
Right, the intriguing idea that the rest of the world can slow down, but the US can go on ahead.
Exactly. So there's the optimism would be this hope for this switch over to the US consumer driving the global economy and happening in a seamless way, which I don't see as likely given that the quality of the global recovery in this recovery, I think, is really, really quite poor, probably the worst post-World War II. And things like productivity, things like global capex is contracting, global trade's contracting, all sorts of things that suggest the global economy really is in quite a poor state. Given any comparison post-World War II, really.
Okay, and which makes it that much harder to think that the US truly can stand alone. Now, if we take a look at the next chart, perhaps the single most worrying indicator that you've produced is on inventories and inventory build-ups. Take me through what we see here.
Yeah, that's right. So really, one of the drivers of recessions is often an inventory drawdown, because companies have got carried away. They've built up too much inventory in the good times, and they've overdone it and overstocked. And that's really what we're showing here. And I think the irony of this chart is, I remember back in 05, 06, everyone was talking about the great lean inventories. Now we've got terrific inventory management and IT systems. And of course, we see what happened in 08, 09 as demand slowed, inventory picked up sharply. Inventory's already picked up before recession started. So it's a real risk factor, I think, in terms of a negative for demand growth.
Okay, another clear reason for concern. Now, how about credit for the corporate sector? I mean, are there any reasons for concern that banks are going to start getting more cautious? Capital markets will start getting more cautious?
Yeah, I think there's a good argument for that, and we're starting to actually see that in some of the indicators. The Senior Loan Officers Survey picked up quite sharply last quarter. And if you think about profitability deteriorating, whether it's in high yield or investment grade in the last year, seen investment grade corporates have seen their profitability deteriorate as well. So it's only natural you start to get that tightening of credit conditions, and that almost feeds on itself, especially when the Fed's tightening, not loosening.
Which, of course, we at this moment expect them to start to do next month.
Exactly. So if you were to say to me, I think the Fed's going to loosen now, I'd say, fine, we can probably squeeze another year or two out of this recovery. But with the Fed going the way it's going, I think it's a troubling backdrop for the US.
Okay, one final chart we'll take a quick look at is fixed investment. Again, still growing, but the rate, what matters is the rate of change. Again, the direction is troublesome.
The direction's troublesome, that's right, and you tend to slow down into a recession, and then, of course, the recession dynamic kicks in. Of course, if you layer on top of that the fact the corporate sector's overstretched, short on cash, not really growing its revenues, that becomes more troublesome. You can see the direction of travel is probably going to continue down. So, yes, exactly. Another sort of piece of evidence that there's some riskiness in this US recovery.
And just finally, let's be clear, we are talking about a recession along the lines of this one and this one, rather than the Great Recession of 2009, right? There's nothing to indicate that something as horrific as that is coming down the pike.
Not at all. And in fact, if for a recession like 07, 09, you need lots of excess in the US economy, which you can't really see at the moment. The corporate sector's overdone it a bit, inventories you touched on and so on. The excess in this cycle is really overseas and feeding back into the US. I think one great stat that's been bandied around recently is the 50 trillion increase in global debt in this economic cycle. which of course is about 3 times the growth in nominal GDP. So that's where the excess is.
That's
The
a little
economy,
early, right.
it is troubling. It is troubling, and that's where, of course, a lot of the excess is this time. So a small US recession, and perhaps more trouble elsewhere in other parts of the world.
Okay, Chris, thank you very much indeed. That is the bear case for the US economy. Plainly, it doesn't look as though the economy itself is in that much trouble, given the kind of valuations that US stocks are trading at. A small recession for the US could still mean a rather bigger market event in consequence.